If you don't have steel, you don't have a country. You don't have a country. A 25% increase. We're going to bring it from 25% to 50%, the tariffs on steel into the United States of America, which will even further secure the steel industry in the United States. Nobody's going to...
When President Donald Trump hiked tariffs on imported steel and aluminum from 25% to 50%, North America's most peaceful border was instantly transformed into an economic battlefield. In a stunning move at the end of March, Trump used Section 232 of U.S. trade law, typically aimed at adversaries like China or Russia, to double tariffs on metals from Canada and Mexico. This shift blindsided both industry leaders and allies, including G7 members and NATO partners. Canada reacted swiftly. Containers at the Port of Vancouver were turned away. U.S. automakers in Detroit scrambled for materials. The integrated North American metal trade was suddenly fractured, and all eyes turned to July 16th, a critical date in what media began calling the Metal War. But this wasn't just a tariff dispute, it was a test of the economic foundation that supported North America for decades. The end of free metal trade? Trump's new tariffs broke one of the main pillars of North American integration, the free flow of metal across borders. The shock reverberated across markets. The dollar index surged 1%. Metal futures on the Chicago Exchange hit their daily limits. Supply chain managers in Detroit and Windsor rushed to revise orders. In Ottawa, political tensions flared. Prime Minister Mark Carney coined a new phrase, the single Canadian economy, a break from decades of North American integration rhetoric. Canada, in short, was going solo. Canada's strategic counterstrike. In response, Ottawa implemented a reciprocal framework using emergency powers under the Canadian Customs Tariff Act. Starting July 21st, a baseline 25% tariff was introduced on U.S. origin steel and aluminum, automatically adjustable based on progress in diplomatic talks. This dynamic tariff model was the first of its kind since 1990, letting Canada increase or decrease rates without waiting for a cabinet vote. The tariff rates would reflect the status of security and economic negotiations, with the U.S. introducing flexibility into trade retaliation. Public procurement filter and strategic quotas. François-Philippe Champagne, Canada's industry minister, unveiled two more retaliatory levers, a procurement filter and a strategic quota system. The procurement rule required that all federally funded infrastructure projects, from Navy shipbuilding to Prairie high-speed rail, prioritize domestically sourced metals. While tenders remained open internationally, U.S. suppliers now had to prove their metals were melted and cast in Canada to remain eligible. The quota system set origin-based import caps on various steel and aluminum products. And notably, these caps applied retroactively to shipments dating back to January 1st, 2025, affecting containers already waiting in Canadian ports. The $10 billion BETCO Lifeline. To soften the blow for Canadian manufacturers, the government launched the BETCO program. Bridge Economic Tariff Credit Offer. This $10 billion initiative offered up to $50 million in low-interest loans per company for those deemed strategically vital. In exchange, companies had to submit supply chain relocation plans inside Canada's northern border, encouraging a long-term shift to reshoring.